Look at the smartphone sitting in this storefront window. That digital hardware triggered a massive spike in e-commerce, forcing India's physical logistics sector to rapidly scale into a 28 lakh crore market. The introduction of the goods and services tax accelerated the expansion. Companies shut down their scattered state-by-state warehouses and consolidated their inventory into massive centralized hubs, kicking off a frantic race to capture market share. The rapid expansion was subsidized by debt and heavy operating losses. Companies focused entirely on scaling their delivery volume, ignoring the underlying unit economics of the individual trips they were making. By 2024, the capital dried up. E-com Express, a massive player in the space, watched its valuation drop by 80%, forcing the company into a 1,400 crore distress sale. The logistics market is now a strict survival game. Investors demand clean unit economics, and the only metric keeping a company alive is pure profitability. These transport trucks form the physical backbone. The industry breaks into 3 weight tiers: express parcel, part truckload, and full truckload. This Air India cargo plane sits at the peak. Air Express commands extreme pricing power and near-zero return rates, yielding the highest margins. This animated schematic illustrates the massive drag on standard business-to-consumer express delivery. Roughly 1 in 4 e-commerce orders gets returned, reversing the supply chain and instantly draining the margin from that route. Below standard e-commerce is the emerging quick commerce sector. 10-minute grocery deliveries demand chaotic, high-speed trips for extremely low order values, leaving almost zero room for profit. Moving millions of packages a day guarantees nothing if those deliveries are skewed toward high-return, low-margin segments. The revenue mix dictates whether a company prints money or bleeds cash. This truck schematic breaks down network density. The horizontal line is fixed infrastructure cost, staying the same for a 5 or 500 kilogram payload. Once the load surpasses that line to 2,000 kilograms, extra capacity converts directly to pure profit. Logistics giants used this operating leverage. They built massive automated hubs, driving high volumes through existing infrastructure to extract margin on every extra parcel. Expanding into Tier 2 and Tier 3 cities breaks that mathematical advantage. Vehicles cover long, isolated routes for single drops and drive back completely empty. Operating a logistics network is a physical game of Tetris. Success relies entirely on ruthlessly maximizing utilized space inside every vehicle before it leaves. Third-party logistics providers now face an internal threat. Their biggest clients, companies like Amazon, Flipkart, and Meesho, are aggressively building out their own private delivery fleets. Meesho's internal logistics arm, Valmo, absorbed 67% of the company's shipments in a single year. That evaporation of demand starved e-com Express of its primary revenue source and forced its collapse. To survive client abandonment, logistics companies have to stop relying solely on physical assets. They are shifting capital into deep technological moats. These multi-level automated conveyor belts represent the necessary capital expenditure. Manual sorting costs up to 18 rupees per parcel. Extreme automation drops that cost down to 6 rupees, neutralizing annual wage inflation. This digital map interface displays AI route optimization in real time. When a logistics provider integrates this routing data directly into a client's API, the switching costs become prohibitive. The client is locked into the ecosystem. Ultimately, modern logistics is an algorithms war. The company that writes the most efficient code, rather than deploying the largest number of trucks, will survive the profitability pivot.